Hello, I'm Roger Peterson, and welcome to Market Call. Rebecca Teltscher is on the show, and she's a portfolio manager at Newhaven Asset Management, and we'll be taking your questions on Canadian Dividend Stocks. And you can reach us toll-free at 1-855-326-6266. Also, send us an email, marketcall@bnnbloomberg.ca. All right, Rebecca, thank you very much for joining us. We appreciate taking the time to come into the new studios. How are you liking it so far?
Yeah, I mean, huge studio, so and a nice, beautiful view of the 401. What's not to like?
All right, the markets right now, there's lots to like about the markets. It just keeps going gangbusters.
Yeah, I don't even know what to say. I think this is going to be the easiest show for me because I think almost every question I'm going to get is, maybe a good company, but too expensive or too high. I just think, the market is in, mania territory, more so in the US than in Canada. But wow, it just seems like nothing is, it just seems like a runaway train and nothing can stop it.
Does it make you want to maybe take a breath and pause a little bit?
So we are conservative investors on a good day, let alone on a day where valuations are this high. But we have to balance that with collecting dividends. We're all about dividend investing. And unless you're invested, you're not collecting that dividend. So, we try not to trade buy low, sell high, and we're not trying to time the market. We're all about getting invested, collecting those dividends, compounding those dividends over time. That being said, for new money coming into the market, we're having a hard time deploying it right now.
Is there any particular places you're looking, or is it
so again,
where you find it?
Yeah, so again, Canadian valuations are trading at half of what it is in the US. So we still think that there's relative valuation in Canada. We think, in particular, we like infrastructure stocks, things that are going to back the backbone of the Canadian economy. So, utilities, pipelines, telcos, energy infrastructure, just because our overall thesis, along with collecting dividends, but we really believe that increasing power demand is a secular trend, and it's going to continue to increase over the next 20, 30, 40 years. So despite where we are in the economy right now, which we believe we're going into, economic weakness, possibly a recession, but despite all that, we do think that growth in power demand, it's not only defensive, but it's a growing trend that could supersede any economic weakness we would see in the short term.
And what are some of the indicators right now that we might be heading into possibly a recession?
Well, it's no secret for months now, the economic data has been trending negative. GDP numbers were positive in the United States, I think it was last week, but, that's a little bit of a backward-looking data. But if you look at, job numbers, they've been coming in weak. And also, with this government shutdown, we're going to be not getting as much economic data. So who knows, what the economy is telling us this week or next. But again, the market is not wavering. It just continues, going higher and higher. Inflation risk is increasingly getting higher as tariffs are starting to see an impact right now. I think the economy was saved in the first two quarters because there was a lot of buy forward or pulling forward of demand. But now we're going to start to see those numbers come off as tariffs really take impact, as employment numbers start to show through. And, if the shutdown continues, there'll be more unemployment numbers coming through in the next few months as well.
Is that the main concern with the shutdown? Is not getting the numbers for you? Is that?
Well, for us, I think the market likes to see certain numbers, but again, I've been saying this for months that the market's been ignoring a lot of the economic data because, employment numbers were coming in really negative, and instead of the market going down, it was going up because analysts were like, well, that means there's going to be a rate cut, which is what happened. So, we were in a territory where bad news is good news and maybe good news is good news. And so I really don't know what's going to make the market turn. I do know these valuations are unsustainable. So I'm not sure what it is that's going to cause the market to turn, but we're very cautious right now, and we're just wanting to deploy money where we see long-term value, and we're not trying to bank on these short-term trends.
Now, you also mentioned maybe inflation making a reappearance. So would that affect then the Bank of Canada rate? Talks of another cut. Would that be on hold?
It could more. I think inflation is more of a risk in the United States than it is in Canada. I do think, let's just say we are headed into a recession. Canada is probably a little bit more ahead than the United States when it comes to that. We've seen like our GDP numbers are lower. We've seen our employment numbers have been, worse in the U.S. for longer. And our consumer, I think the consumers in Canada are more strapped. So consumer spending has been slowing down for longer. We have mortgage rules that are different than the United States. So we have our 5-year resets, whereas in the United States, that's not an issue. So consumers in Canada are going to be paying higher for their mortgages that were locked in at really historic low pandemic rates. Whereas in the United States, maybe the consumer is stronger for now. So I do think inflation numbers are going to be more of a factor in the U.S. than it is in Canada. Okay.
Rebecca, thank you very much for joining us. We got lots of people wanting to get questions into you, so we'll get to those coming up after the break. You can call us toll free at 1-855-326-6266 or send us an email, marketcall@bnnbloomberg.ca. We'll be back with Rebecca Teltscher, the portfolio manager at Newhaven Asset Management. She'll be taking your questions on Canadian Dividend Stocks. There's those numbers again for you. Market Call, and we are joined by Rebecca Teltscher, who is the portfolio manager at Newhaven Asset Management. Rebecca, thanks for joining us. Let's get into your emails first, and we're going to get some calls as well. But first up is an email from Sunny, and he says, I'm thinking of selling SU and would appreciate your take on it.
Yep, absolutely. So Suncor, it's funny, like I said, we're long-term investors. I rarely recommend, switches for, short-term valuation. But actually, in this case, I'm going to recommend a switch, not for short-term valuation metrics, but really, I think there's an opportunity to get a better or a name we prefer in the energy space for a longer for the longer term. So Suncor, historically had been plagued with, there were, incidents that happened. They have more aging production. They're going to have to secure new oil production to replace that decline from that base mine that is getting close to the end of its useful life. So they have older assets, and I think there's an opportunity right now to switch that to CNQ. I mean, CNQ is our favorite name in the oil space. Lower decline assets, newer assets, one of the strongest management teams, not just in the energy space, but I think in the world or in Canada. So you're also getting an increase in dividend yield, so about 4% for Suncor and about 5.5% or 5.3% for CNQ. So you get higher dividend rate to own premium assets with a better management team. I want to mention that Suncor did change its management team, so they are doing all the right things. They have a new CEO. They have been the stock, and that's why the stock has been performing well. They've done the operational turnaround, but you've seen that now. The stock price is performed really well. CNQ's kind of languished a little bit, but I think now is a really good opportunity to switch for higher dividend and better quality assets for the longer term. Okay. I would recommend selling to go into CNQ if you can.
And when you see new management come in, how long do you like to give them to see where they're going or what they're doing?
Yeah, I mean, I think we have to give them time. So it takes, a few years. And I think that, Suncor has done a good job with the new CEO has done a good job in turnaround, but that they still do have to replace the decline in their production from some of their older assets that are going to come offline, whereas CNQ doesn't have those issues because their assets are newer. All
right, still more questions than answers then, right?
Yeah.
Okay, let's get to our calls. And John, you're calling from London. What's your question?
Hello, Ross. Thank you, Rebecca. Rebecca, I've been studying gold today, and I've seen price targets, one-year price targets in the $4,400 to $4,700 range, U.S. I can't believe it.
Wow.
I bought Agnico Eagle Gold about, 2.5 years ago, and I looked at the earnings curve per quarter, and it's parabolic over the last 6 or 7 quarters. convinced me that I shouldn't add to Agnico Eagle Gold today. Thanks very much.
Oof. Again, this is going to be my theme. Good company, but God, it's hard to buy right now. Agnico Eagle is the only gold producer we have in our portfolio. And we owned it when gold prices were normalized and weren't, as you mentioned, like on this parabolic curve. I think when we bought it, the yield was over 3%. Now it's less than 1%. And again, we're all about that safety. You want to collect that dividend so that way, even if the stock price is off, on a given year, at least you're collecting that dividend up front and you can kind of wait to see the stock price recover. In this case, less than 1% for dividend yield, you're not really giving that much of a buffer and you're really banking on that stock price maintaining it at these levels. The stock price more than doubled last year and is up about 72% this year, again, on top of that double from last year. I still like the company, right? So I still like, 90% of their assets are in really good jurisdictions. So, Canada, Mexico, Finland, relative to some of the other Canadian gold stocks that have a little bit more geopolitical risk. So it is my favorite gold stock in Canada, and that's why we continue to own it. But I'm having trouble adding to it at these levels. I think we need to see some of that steam come off of that name, that valuation to come off a little bit. So I'm not saying to not own it. I'm saying if you have it, keep it, maybe wait before adding more. But again, who's to say? It's gold is close to $4,000.
Yeah, it's hovering right around there.
I remember a month or two ago, it reached $3,000 for the first time. So I mean, it's really hard to say. It's the Canadian market is really at all-time highs because of gold. The U.S. market's at all-time highs because of technology. I don't know, two different stories right now, because usually you buy gold as a safe haven when you're looking to get money out of the market and to invest in stability when you think that there is political turmoil or economic turmoil. But then all the other sectors are doing well also. So it's really hard to say. But Agnico Eagle, we like the stock. Not so much the valuation right now.
Okay, and when you mentioned the 1% on the dividends, what's the number you like to see?
I mean, again, it really depends on the sector, depends on, but like I said, when we were buying it, it was over 3%. But at this point, I mean, I think I'd be happy if we can get it over 2%. But I mean, it has a long way to go if it gets to a 2% dividend yield from here.
Okay. Let's go and move on to Chris from Victoria. What's your question?
Oh, good morning, Rebecca. It's great to see you back on the show. Rebecca, I'd first really quickly just like to ask you at Newhaven, what is the minimum investment amount that one needs to bring to your firm? And as well, I'd like to ask you on Canadian Tire. I heard a really good thesis for this company and this long-term value manager. I believe her first name was Kim, but I'm not remembering her full name. And so I took a little position. It's up a bit. It has a dividend, a substantial one. And I'm just wondering what you think of it. I was kind of surprised to learn that they're actually a franchise model. They seem pretty cut and paste to me whenever I go into them. So I'd appreciate your thoughts. Thank you so much.
Absolutely. Thanks for the question. So first, with regards to Newhaven's minimum, why don't you send me an email? It's on the website. We can kind of have that discussion because we don't have necessarily a set minimum, and it really just depends on what, if you're adding to your portfolio or withdrawing from it. As I've said many times, we really want to focus on the dividend income coming in. And if you're going to be withdrawing more than the income, that means you're relying too much on capital appreciation or the market. And we want to make sure that enough of your withdrawals can come from dividend income. So it really, can change from person to person and depending where you are in your cycle, if you're still employed or retired. So let's have that conversation offline. With regards to Canadian Tire, it's so interesting because, yes, it is a franchise model. And that's actually one of the reasons why they were delayed at doing a lot of, things that you would think are self-explanatory. So a transactional website, for example, companies like Home Depot and Lowe's in the United States, they were able to do a transactional website many years before Canadian Tire was able to launch that because of that franchise model. So if you're doing a transactional website where you can purchase from the website, it was detrimental to stores in specific that were franchise owned. So where do you, source that inventory from? Does it come out of the corporate revenue? Is it corporate revenues? Is it store revenue? So, it seems like they've been able to sort out some of those kinks, but it, it does cause some issues when you're looking at, firm-wide changes. With regards to Canadian Tire, so as you mentioned, 4.3% dividend yield. Obviously, it's something that we would look at because we like that yield. We don't think that yield is at risk. That being said, as I've mentioned, in Canada in particular, we think we're heading towards possibly a recession, possibly economic weakness. Mm-hmm. The Canadian consumer, we feel right now, is spending the majority of their income on housing or mortgages. And then beyond that, most of their discretionary spending is going to be on, groceries and gas prices. So that leaves not so much extra on discretionary items. And that's kind of what Canadian Tire's bread and butter is with regards to, smaller appliances.
So with caution then, I guess, with Canadian
exactly.
Tire.
Yeah, exactly. And I think that's why, the stock was off about 23% last year and it's up this year, but not in line with the market. And I think there is that caution on consumer weakness and economic weakness. So I'd hold off on that one right now. I think it's a good company. I like that they operate in some really areas in Canada where they're possibly, the only, they have a monopoly in that space. Mm-hmm. But I think I'd be nervous right now to buy any discretionary name.
Okay. All right, Rebecca, we'll be back with you in just a second here. Rebecca Teltscher is the portfolio manager at Newhaven Asset Management. She'll be taking your questions on Canadian dividend stocks. Welcome back to Market Call. Rebecca Teltscher from Newhaven Asset Management is with us right now taking your calls, and that's where we're going to head to Dawson Creek and Fleming. What's your question, Fleming?
Good morning, Roger. Good morning, Rebecca.
Good morning.
Morning.
My question's on Allied Properties. Do you think it's ever going to get back to its former glory?
Good question. So Allied Property is a name that we looked into about a year ago. Again, we were attracted to that dividend yield. It was over, 10% at the time. And we like the locations of their assets. So they focus on downtown cores, the majority, downtown Vancouver, Toronto, Montreal. Mm-hmm. And they have these really unique properties. So like these old, brick-faced buildings that are maybe like lower, and then what they have the retail on the bottom, and then they kind of put the office space on top. So they're really unique properties. So we really liked that. It was all about urbanization towards central downtown core, and then what happened? The pandemic happened, and so there was that exodus of the downtown core, that work from home, and that's when that stock really came off during the pandemic. So we spoke with management. We felt as if, and we saw other office properties cut their dividends during this time in about 2023, 2024. So, after speaking with management, we weren't so convinced, and we're still not so convinced on the worst is being over for office space. I think the stock has, if you put a shorter term chart, you'll see the stock really ramped up this year. It's up 23% year to date. And you're seeing, a lot of this talk about back to the office. But if you think about the companies that are back to the office, it's mostly financials, telcos that are kind of forcing to return. That's not necessarily Allied's most of their tenants. Like, that's not really their properties. They are, again, they're more of a niche, they're niche properties. So, I think Shopify, so, technology, marketing firms. So, I think they're a little bit behind with regards to we need more information on that return to office, if that's going to impact, some of the tech companies, some of the, marketing and design firms, which are more of their tenants. And I think the stock has really, ramped up a lot this year. And again, expectations, like, they haven't decreased their guidance. And so those expectations for the last quarter this year is really high. So I think that stock has ran up ahead of itself, and either they are going to meet these really high expectations and the stock will continue. But I think there is a higher chance that they don't meet expectations, guidance comes down, and that stock comes down as well. So I like the properties. I don't like the stock right now.
Okay. And let's move on down. We'll get to Mike from St. John, New Brunswick. What's your question, Mike?
Oh, good afternoon. Hi, Rebecca. Freehold royalties. I'm looking to take a position. I just wonder, do you hold it? And just want to get your thoughts. I really like the dividend.
Yeah. So do we, and we do own it for that dividend. Not just for the dividend, but I mean, I think when it comes to a company that has a yield of about 8%, right now it's a little bit below because the stock price has done well, but it was, I mean, over 9% at one point. When you're buying a company that has a yield of 8%, we don't expect the stock price to do that much else. So it's trading, around $14. Stocks up 6% this year. So again, not as much as the market, but considering, what oil prices are doing and considering that yield, we're okay with that. So it's a royalty company. What we like about it is that it has a pretty low break-even price. So, for it to cut its dividend, and it has cut the dividend in the past, but they're very transparent about it. They're very transparent that they have a break-even price at around, I think it's about $50. So as long as oil prices stay above that price, they're okay to maintain that dividend. They've cut it in the past, but as soon as oil prices get back up, they're the first to raise their dividends again. So we like the management team. They are a royalty company, so they're not spending money on drilling and exploration. And they've now entered in the U.S. We're probably going to see some more acquisitions in the U.S. with regards to oil land properties. More competitive there, but I think there's a little bit more growth there than in Canada. So again, happy to own it, mostly for the dividend, and whatever we can get on the stock price is just an added bonus for us.
Okay. And let's go on to Mark from Ottawa. Mark, you there? Okay, we lost Mark. You wanted to talk? We can chat. You want to talk about Tourmaline?
Sure. Let's talk about some Tourmaline. It is the largest natural gas producer, along with CNQ, which is, we talked about earlier as my favorite oil stock, but actually CNQ also produces a lot of gas. And we like Tourmaline, a very strong management team. There is a gas name that we like a little bit more. It's in my top pick, so we could talk about it a little bit later.
Okay, yeah.
But the one thing I'll say about Tourmaline is that it's going to continue. It has to continue to do M&A to basically fund its growth plan, whereas the name that we prefer has a lot of reserves in their inventory, so they don't necessarily have to keep buying. So that's why we like it better. But that being said, we do like Tourmaline's assets. We like their management. Stock's down about 10%. Again, natural gas prices they've suffered. We have a warmer than expected fall right now. There's a little bit too much supply as we are ramping up with LNG exports, and there are, projects to get, natural gas off the coast of Canada and into, Asian or international markets. But until that continues to ramp up, we're looking at too much supply on natural gas and a warmer winter. So again, natural gas prices should go higher. We're starting to see, that cooling weather start to kick in now. So we like it. And if you own it already, which I'm not sure because the caller dropped off, if you own it already, continue to own it. But if you're looking to enter that natural gas space, stay tuned for that top pick, because there's one that I'll introduce a little bit later that we like just a little bit more.
All right, and that's coming up soon. We're going to take a quick break, but when we come back, we'll take a look at Rebecca's past picks and see how they did that stand. Welcome back to Market Call. Rebecca Teltscher from Newhaven Asset Management is with us. And now we're going to look at your past picks from almost about a year ago, September of last year. So pretty close to a year ago. We're going to take a look and see how you did. First up, Brookfield Renewable Partners. And what are we seeing? It's a return 9%. That was what you picked. Total return 15%. How are we doing with it now? You happy with it?
Yeah. You know what? It's, I think those prices are in US dollars because We own it in Canadian dollars, and it's in the 30s. But again, we're happy. Yeah, see, like 38.11 in Canadian dollars. So we're happy to continue.
Yeah, it's 38. Just looking at it. A little
Yeah,
slow there. Sorry.
yeah, no, that's okay. I was just confused when I saw the price in the 20s. I'm like, it hasn't come down. No, it's done well. Again, it's a renewable company. It focuses on, they have a lot of hydro assets, international hydro assets in Colombia. They actually just announced $1 billion of investments in their Colombia hydro assets, long life assets. Again, we like those. But I think what's more topical is these data centers that are happening all over North America. And now I think we've seen 2 power purchase agreements with corporate parties. So last year they announced Microsoft, one of the biggest corporate PPAs in history, that they're going to deliver wind and solar for the next 5 years across jurisdictions in North America. And I believe last quarter they announced a hydro framework with Google. So I don't think this is the end of what we're going to see is corporate PPAs, those large hyperscalers that are looking to secure power. I think I talked about it right at the beginning, that there's a huge increase in power demand, whether it's going to be through the need of data centers, those AI, we're talking about AI, those AI chips use massive amount of power, whether it's going to be in, bringing industrial back to North America. So that reshoring, huge power consumption. We're coming off coal. We're going to need either nuclear or natural gas and renewables to be able to fund that grid. So Brookfield is going to play a large part in that. There's a few other renewable names that we like as well, but Brookfield is definitely one of them. And I think we're going to see more of these corporate contracts going forward. So we're happy to own it, and it has a pretty good dividend yield in the meantime as well. That is growing in about 5% a year.
And demand for renewables still there?
Absolutely. I think, stocks came off more so in the U.S. when, there was that big, beautiful bill that was talking about reducing tax credits in the U.S. And Brookfield Renewables came off a little bit because they do have exposure to power in the U.S. But again, Brookfield, with the head company, they also, they have jurisdictions all over the world, so they're able to redeploy that capital and that growth as needed. Okay.
Next up for you is TC Energy. Let's take a look how it's doing. It's the return 32%, total return 40. It's at 76.20. You recommended it at 63.23.
It's anything. This market is going to make anyone look good right now. I'm not taking credit for this. This is the market.
Take the credit, don't worry.
This is the market. TC Energy is, one of the largest pipelines in North America, focused on natural gas. That natural gas infrastructure through that NGTL. They have a lot of natural gas pipelines in Mexico, U.S., through the Columbia acquisition, and in Canada. We liked it at the time. I think I recommended it. It had a 7% dividend yield. Now it's come off a lot more. And it continues to do well. I think there's a lot of need for that infrastructure going forward. We kind of talked about natural gas egress, off of the coast to Asian markets that need that natural gas. Think about a country like China. They're still putting up coal plants today. It kind of sounds crazy because, we've come off our coal in the past decade in Canada and the U.S. We're decreasing our exposure to coal, whereas China is still adding to it. Why? Because they don't have access to other sources like natural gas. So if something like Canada is able to supply natural gas to countries like Asia, they may stop putting up their coal plants and securing, natural gas to put up natural gas plants. And TransCanada is part of that. They're the ones that constructed the Coastal GasLink that is the pipeline that feeds to LNG Canada. So I think they have a strong future.
And with those overseas markets, especially, in China, they've talked about it being one of the green leaders. Any concerns that their demand for natural gas may drop?
Not right now, no.
Yeah.
Until if we're talking about one of the green leaders, we need an alternative to, renewables. Unfortunately, there's a lot of research right now on storage, but there's no efficient and economic way to store large-scale renewable electricity demand right now. So I don't think renewable power is going anywhere. But unfortunately, we still need to source power when the wind stops blowing or when the lights, when the sun goes down. And so we think that's going to have to be natural gas or nuclear. And so I think we're looking at a situation over the next 20, 30 years where you're going to see growth in both renewable and natural gas and nuclear at the same time.
Okay, and your next pick would be TELUS. Let's see how TELUS is doing here. Down slightly from where it was recommended at 22.71. It's at 21.56 right now.
Yeah. So, again, so the stock TELUS is up about 11% year to date, still has a 7.6% dividend yield. I recommended it a year ago when I thought we were going to see weakness in the stock market, and boy, was I wrong on that one. And so I chose a stock that I thought was very defensive. Mm-hmm. Usually, telcos along with utilities, they perform really well in a weakening environment, economic environment. If you think about it, we talked about Canadian Tire. If people are trying to penny pinch or save their money, if they are worried about losing their jobs, they are most likely going to stop buying new cars and their Starbucks coffee. They're most likely not going to cut their internet or cell phones, or their or the electricity in their house. So we like telcos for their defensive characteristics. With regards to our telcos, we like TELUS, one, because of their dividend yield, and the dividend is safe. And also, they're a little bit more ahead of that CapEx program, that fiber to the home. They're about to start their copper decommissioning, which they can get some revenue from there. So they're a little bit more ahead of that large CapEx spend. So we're going to see CapEx coming off in the next few quarters. So we like TELUS for their balance sheet's a little bit stronger than some of the others. Yep. But again, we like the defensive traits.
Yeah, worth holding on to, in other words.
Absolutely. So if I liked it a year ago because I was worried about economic weakness, I definitely like it now.
All right, Rebecca. We're going to come back, but we'll be back with Rebecca Teltscher, Portfolio Manager at Newhaven Asset Management, and she'll be taking more of your questions on Canadian Dividend Stocks. Rebecca Teltscher is here from Newhaven with us. Let's get to your calls right away. Daniel from Markham, what's your question?
Hi, Roger. Hi, Rebecca. Great new host and guest as usual. My question is on Peyto Exploration. Is this a company for an alternate pick in natural gas upside, or do you prefer ARC Resources as the best play? Thanks for taking my call.
Yep. All right. Okay. I was told to move quickly so we could get as many callers as possible, and I talk way too much. So I'm going to try to do this really quick. Peyto, 7% dividend, which is really attractive. But the type of gas they do is mostly dry gas. Dry gas is dry gas is really like the natural gas prices that have come off quite a bit. Whereas wet gas, like you mentioned, ARC Resources, has a little bit more flexibility because of the condensate that they could take out that they need for to ship on the pipelines as diluent to mix with heavy oil. So, we're seeing this a lot with some of the natural gas producers. They're shutting in production, so they're voluntarily taking production offline and waiting for natural gas prices to get higher. Stock price is up, 11% year to date, considering their production is probably coming down. I would hold off. You mentioned ARC Resources. Stay tuned till for top picks, and I'll talk a little bit about why we like that one a little bit better. And I would hold off on Peyto. Nothing wrong with the company or management. Just we prefer the liquids-rich gas versus the drier gas.
Okay, let's get to our next caller, David from Ottawa.
Yes, hi. Good afternoon. Thank you for taking my call. My question is on the Royal Bank, and basically all the banks have done really well. And investors are willing to pay more for the Royal Bank. But given its yield, which is the lowest of all the banks, of the five big banks, do you think Royal Bank is expensive right now? And would you switch to another bank? I'm a dividend investor as well, and banks are my favorite. And what is your choice? Thank you very much. Have a great day.
Yeah.
All right. Thanks, Jacob.
Wouldn't be BNN without a bank question. So Royal Bank, premium assets for premium bank, and you're going to pay a premium valuation for it. So yes, we think it's expensive. Yes, we still like the name. I don't know if I want to buy it over $200 though. I'll tell you what I did. So all the banks have done really well since their earnings last quarter. And I'll tell you what I didn't like about their earnings. and not just Royal, but a lot of them, is that, they released provisions back into earnings. So you think about it, when you're going into economic weakness, banks will take provisions, so the PCLs, provisions for credit losses. So they're taking, and that impacts their earnings right away. And so they're basically anticipating losses. And they did that a lot when, there was a lot of tariff uncertainty back in April. So again, the worst case scenario didn't come to fruition. And so they released those earnings back. And I thought that was a little bit preemptive. Yes, we're not in the worst case tariff scenario, but if we are going through economic weakness, I think it was maybe a little bit premature to take those higher earnings now and release those provisions and say, you know what, we're probably at the peak of the credit cycle and things are getting better. I probably think things might get worse before they get better. Maybe I'm being a little bit pessimistic, but I thought that the bank earnings were very optimistic. And so I'm not necessarily buying the run that's happened in the banks in the past few months. So I'm holding off on buying any bank right now. And again, Scotia has the highest yield right now, but they do have a little bit more, uncertainty with regards to selling down some of their international assets, and they're buying a little bit more U.S., but I'm not buying any banks right now. Let's just put it that way. Okay. If you have them in the portfolio, keep them. But adding to them right now, I would hold off.
All right. Let's get in one more caller here. Jacob from Toronto. What's your question?
Yes. Good afternoon to you. Good afternoon, Rebecca. I'd like to know if you can tell me a bedtime story about Brookfield Corporation. It's in the wind, swinging back and forth. Do I keep it? Do I sell it? And also if you have it in your portfolio. Thank you very much and have a nice afternoon.
Thank you, Jacob.
Yep. We don't own it in our portfolio. 0.5% dividend yield. It's hard to buy. The stock was up 62% last year, another 15% this year. But what we did see, you see like in April when the stock was just on that chart, the chart was on the screen, it really underperformed in April. So it just shows how much torque there is to the upside, but also to the downside. So more volatile, more cyclical than our Canadian banks and our portfolio in general. So again, it owns a lot of alternative investments through, the oak tree, and it owns all that real estate. So a lot of office real estate. And again, like I mentioned, I'm not sure where that's going. Okay. Instead, we prefer to own some of their underlying investments. So Brookfield Renewables that we view as safer. It was one of my past picks. Brookfield Infrastructure. We like some of those assets that have higher dividend yields, and those assets are a lot more what we view as safer because they're backed by long-term contracts. And they're more in, the energy, utility, transportation space. Okay. So we prefer to own, Brookfield entities through those vehicles as opposed to the parent corporation.
All right. Well, we're going to take a quick break here, but we'll be back with Rebecca Teltscher, portfolio manager, Newhaven Asset Management, and she'll get in a few more questions from you on Canadian Dividend Stocks. The numbers are up now. Okay, let's get right back to your calls. And Chris from Hamilton, you're up.
Oh, good afternoon. Thank you for taking my call. I'd like Rebecca's point of view on Dream Industrial REIT and whether she thinks going forward it's a worthwhile hold, and would she be adding to it at these levels?
Okay, thanks, Chris.
So not a name that we own, even though the yield is, 5.6%, which is attractive at these valuations. But I think with the industrial REITs in general, we saw a huge pandemic build, and that causes all the stocks to soar and just a lot of new industrial projects coming online. But going forward, I think those starts are going to slow down. So I also think that there's lower barrier to entry. So I failed to see where that future growth is, and I think that new growth is going to be a lot more competitive. So for that reason, we've just stayed away from the industrial REIT space.
Okay, fair point. Let's get in one last call here. Amin from Ottawa.
Good afternoon. My question for our guest is, which is a better buy, Pembina or Ambridge? Okay. Thank you and have a nice day.
And go.
Yes. Okay. How much time do I have? We like both. We own both.
You have 1 minute, actually.
1 minute. Okay. We like both. But what I will say is I do think Enbridge has kind of seen that growth. It's one of the, TransCanada or TC Energy and Enbridge, the larger pipelines, can kind of seen that flow of funds. Whereas Pembina kind of lagged for a lot of this year. It was, flat to negative for most of the year up until last week, and I'll tell you why. But Pembina's really hasn't done that much, and we were scratching our head. We were buying more for all our clients, and then what happened last week? Actually, just this morning, they announced a huge, again, another corporate PPA rumored to be Meta, although not confirmed. But they're going to be building a natural gas power plant, with capacity up to 1,800 megawatts in Alberta over the next few years. There's been rumors about data centers coming to Alberta for a long time. This is the first one to come to fruition. Interesting that it wasn't Capital Power or TransAlta, but Pembina, because they have such a strong management team and a strong track record. Okay. So we like Pembina. We like their integrated infrastructure. We also like Enbridge, but if I had to buy one today, it would be Pembina.
Okay, and we're going to leave it on that note. That's all the time we have for calls for today, but don't go away. Rebecca will be sharing her top picks coming up next. Join us on Market Call tomorrow. Darren Sissons will be on the show. Is with Campbell, Lee and Ross Investment Management, Global and Technology Stocks is where we'll be taking your questions from. All right, time now for Rebecca's top picks. Shall we get started with Aecon?
Sure. So just met with management last week just to get an update. It's been a little bit more of a volatile stock than usual because they've been plagued by these legacy fixed price contracts that were taken around the pandemic. So we think Eglinton LRT, the Gordie Howe Bridge, the Coastal GasLink. So different projects, but what happened during the pandemic is that they went through a lot of cost overruns, supply issues, a lot of delays. We're really at the very, very tail end of that. So a lot of these projects Coastal GasLink has been settled. That's done. The LRT should be at the end of this year. Gordie Howe at the end of this year, possibly next year. If you think about their backlog, less than 1% of their backlog is now with regards to these legacy price contracts. They had a parameter of about 150 million in losses that they can take additional. They may go over that. I do believe that they could go over that. So it's interesting because I'm recommending a top pick that I do think can go lower from here, but I do think it'll recover once the noise of those legacy projects are behind them, and they really focus on that backlog. They're at record backlog in their entire history, over $10 billion, $1 billion added to their backlog just last quarter. A lot of their growth is in the utility space. They're doing all the nuclear refurbishments in Ontario. There's a lot of talk with regards to nuclear, whether that turns into contracts outside of Ontario. I think we're a few years away, but again, that would secure even additional growth in their backlog. A lot of public sector growth, I think, with regards to transportation that have been underinvested. And recently they've announced two smaller but U.S. acquisitions in the industrial space. And they source those acquisitions not through a bidding process, but through their existing clients in Canada that has exposure to the U.S., whether it's in oil or mining. And so those U.S. acquisitions, I think, will be great for them to diversify outside of Canada. And I do think that the stock is poised to grow higher. 3% dividend yield. We owned it when it had a 6% dividend yield, but I think they're going to continue to grow their dividends from here as well.
Okay, ARC Resources is next. They look for oil and natural gas.
Absolutely. So this is our favorite natural gas name. Kind of, we talked about it. They have focused more on liquid natural gas. So, some of that condensate, some of those NGLs. Stock's been down 4% because, like I mentioned also, they have a lot of embedded growth because they have huge reserves, about 15 years of reserves from the land that they own in the Montney. And so the stock's been down because they're working on this Attachie project that had a little bit of delays to get started. And so I think there's speculation that the phase 2 of that project may be delayed to next year. We're long-term investors, so we're not fussed if something gets delayed by 1 or 2 quarters. At the end of the day, we're confident on the assets that they own. These are premium assets. We're confident on their management team. They're paying 100% of their free cash flow back in terms of dividends and share buybacks. So this is a name that we want to own in the longer term, and we're happy to own it.
Anything within it that you keep an eye on, though? Or is it all
I think, the Hitachi delays are behind them. I think we have a strong management team. I think they're on the conservative side, so they're not going to grow for the sake of growing, but they do have a lot of optionality. So, for example, their Sunrise plant, which is a dry gas, they also have a shut-in with regards to taking production offline. If we start to see natural gas prices go up, which we think will happen as we see more egress and as we see more demand for natural gas continue through these new, gas plants, they'll have more optionality to bring more production online.
Okay, and your last pick, Savaria?
Savaria. Yeah, or Savaria, I'm not really sure. Quebec-based company. They're in the accessibility industry. So, think about wheelchair ramps, elevators and stair lifts, as well as, mattress care and bedding. And the whole idea of Savaria is, while it's a discretionary name, we don't view it as discretionary. We view it as needs-based, because you're not buying...
Especially with an aging population.
Absolutely. You're not going to buy a wheelchair ramp really until you need it. And the whole idea, and that we've seen through the pandemic, is the population, they want to age at home gracefully, and they're going to try to delay moving into retirement residence as long as possible. And those residents like Chartwells have done really well, but we do think Savaria could do well as well. They got hammered at the middle of the year because of tariffs, because they do produce a lot of their, they have facilities in Brampton and in Mexico, as well as China, and a lot of their sales happen in the US, so they were like that poster child for tariffs. But I think what investors fail to realize is that a lot of their products are FDA regulated that are exempt of tariffs. So, the stock has recovered, but it's about where it was prior to tariffs. And I do think that they can continue to grow from here, especially since they've had their Savaria One initiative, which is a lot of cost cutting and growth, and they're launching new products in the market. So own it for the long term. Perfect ending. Rebecca, thank you very much for joining us. Rebecca Teltscher is the portfolio manager at Newhaven Asset Management. Thanks again. Thank you for watching Market Call. We'll see you next time.